We had an interesting day in the market with some large red right across the board, and the majority of this was in the semiconductor industry. As we can see, some very large names that have been hit. Nvidia down 5%, AMD more than 5%, but interestingly, the one that really hit the market strongly was ASML. Now, they were meant to report today, in fact, before the market opened, and what we can see was that they had reported early, and they essentially blamed this on a technical error. Now, whether or not there is any truth in this, it doesn't really matter, because the numbers were in fact terrible, and we can see they wiped off 50 billion on their market cap, and as we are about to show you, this company continues to decline. Now, what we can see here is they had expected 2025 net sales of around 30 to 35 billion, and they actually said this is in the lower half than what they had previously anticipated. And it was even worse when we come to take a look at their net bookings, which tend to be very strong for this company. We do like to see growth, even if it is over the next year or so. They said for the quarter of September, it was 2.6 billion euros. That is significantly below the 5.6 billion that the market had anticipated. So a lot to worry about if you are a shareholder of ASML. And the question is, how much does that spread to the wider market? We can see here that the CEO pretty much said that there is a lot of upside with AI. However, they believe this is taking a lot longer to recover, and they see this gradually recovering rather than a sharper incline than what they had anticipated. And when we take a look at this company right now, just yesterday it was down nearly 17%. In the pre-market, it is down nearly 5%, so the drop does continue for ASML. And if you want a deeper dive, we did in fact record an episode yesterday, so do check that out. What's also very interesting to note is that tomorrow morning, unless we do get another error, that TSMC, Taiwan Semiconductors, are reporting before the market open. So it will be very key for the semiconductor companies like Nvidia to see how they are reporting. Are we going to see any red flag indicators similar to what we saw for ASML, or will this be able to propel the semiconductor industry back? Because yesterday was a terrible performance right across the board. Right now, though, we can in fact see that Taiwan Semiconductors is up around 1% in the pre-market, and we also get a double strong buy from Wall Street and Quant with a buy from Seeking Alpha. So who knows what happens tomorrow, though. We will be covering this if we do get a very, very bad performance. Now, in terms of Nvidia, this is what we want to focus on today's episode. Is the drop essentially an overreaction, and should we be looking to continually add shares of this company with the AI revolution that we continually get told is just around the corner? Now, over the last year, this company is up 186%, year to date up 166%, and over the last week, even with the drop, it is down only 1%. Again, if you've been a long-term shareholder, you would be up a massive 29,000%. And as we can see, it is only marginally lower than its all-time highs of $141. We still notice Wall Street give this a strong buy, Seeking Alpha again giving this a buy, but Quant, as they typically do, give this a hold. Now, in terms of the yield, very minimal. We just want to highlight they do give out a dividend at 0.03%, and the forward P around 46 is something we will come to discuss. Now, in terms of moving forwards, they are due to report their earnings fairly soon. The next quarter, they're anticipating 84% growth to the EPS year on year, and we can see that trend continue over the next 4 quarters. So they are expecting massive growth, and what's great to see with this company is that they have outperformed analyst targets over the last 4 quarters. That is a 100% track record, and gives us faith that in January 2026, they will be able to hit that estimate of 4.02, lowering down the forward P to just below 33. So lots to love about this company, their historical accuracy as well as the expectations moving forwards. And on top of that, if you want some more bullish news, we have heard from Jensen Huang, the CEO, not too long ago, where he's talking about the demand for their new product Blackwell being insane. In fact, he is saying that everyone wants this product, and they not just want to have the product, they want to be the number one, those who have it first. So we have a CEO who is essentially saying that they can't keep up with the massive demand they're getting, which is unlike what we're seeing from ASML. Granted, this isn't an ASML episode, just something we want to flag. Nvidia doesn't seem right now to have any of the issues that we have noted from the Dutch company. Now, we also want to point out this is a company that continues to grow at a massive rate. Just look at their more recent quarter, Q2 FY25, in comparison to the same quarter last year. They've grown more than double from 13.5 billion to 30 billion in the quarter. And when we see the large driver of the growth in the data center, we can see that is 2.6 times the 10 billion that they reported. And if we continue to see growth in this company, do not expect this share price to come down. Again, will be key to understand if they do have a double beat, which the market expects, but can they increase that guidance? That will be something that will be clearly looked at in detail. Markets now are looking towards forward guidance as opposed to a double beat, which for these valuations, it just expects naturally. Now let's have a quick look at some of the underlying metrics for this very strong company. Dividend safety score, very safe, 89. Not much really to say, it is fairly trivial, and we can see based on the forward PE, it does look to be reasonably valued, although towards the lower end, which we will come on to. And no surprises, they are able to increase the dividend at a very rapid rate, 150% this year, given how much cash from operations they do get, something we will cover. Again, just for consistency on the channel, reaffirmed dividend safety score in September, which means a dividend cut is highly unlikely. Now, in terms of the key metrics, this is essentially from the last recession, 07-09, no dividend, so no comparative data. Recession sales, negative 35%, which was below the average of the S&P at negative 12, but we also note they had a massive underperformance, negative 78, when the S&P, still very poor, but a little bit better at negative 55. Now, you don't really invest in this company for the dividends, but again, to highlight a triple-digit increase this year, 1% on average over the last 5, as this isn't really something they focus on. And in terms of the last 10 years, it has been increasing at around 7% year on year. And we do note they've been paying a dividend for the last 11 years without a reduction. Now, we're going to get to our own valuation model today, but just to show you, based on the 5-year average of the forward PE, when we do zoom into over the last year, the blue tunnel, essentially the intrinsic value, the fair price, it has been up and down over the last 12 months. We notice over the last few months, it is trading still towards the lower end. So based on this model alone, it does look to be reasonably / a little bit undervalued. But remember, we're not looking at any one model today in isolation. We will conclude towards the end. Now, typically for companies that pay out a very high dividend consistently, this would be a metric we consider. It is dividend yield theory, which tells us a company is undervalued when the current yield sits above the 5-year average. Right now, though, it is below. Again, not something we're going to pay too much importance to. Something we will draw your attention to, though, is the forward PE. Right now, it's trading at 39.4, which is below the 5-year average of 42.7, which is an undervaluation signal. No surprises that this company does trade higher than the information technology sector PE of 25.7. But remember, high quality companies will typically trade at a premium. The question isn't, does Nvidia deserve to be a premium company? We already know the answer is yes. The question that we want to answer today is, how much of a premium is this company worth paying? Now, free cash flow payout, we always look at free cash flow data. Earnings is susceptible to manipulation by management through accounting. Below 50% is what we want to see. And look, it has been declining rapidly. It's only 1% in 24, 1% over the next 12 months. So if they really wanted to, management could continue to increase this dividend at a very rapid rate. As we can see though, because they haven't done this, this definitely isn't something of high importance to them. We then move on to the free cash flow per share, where we want to see consistent growth over the longer term. Whilst we don't get consistent growth, we do see massive rapid growth over the last 10 years. Pretty much the growth has come just from 23 to 24 and expected to nearly triple over the next 12 months, which is a very good sign. But do understand this company is in a very cyclical industry, so we may not always continually get massive growth moving forwards. In terms of sales growth, well, 3 to 7%, we already know this is a company that grows their top line at a very rapid rate, nearly double digit every single year. Last year at a triple digit rate, triple digit again on a trailing 12-month basis. And this is really highlighted when we look at it from a numerical perspective. 5 billion in 2015, 61 billion in 2024, so massive growth over the period. Question is, can it continue? Well, look at that on a trailing 12-month basis, it's already more than 50%. In terms of shares outstanding, we love companies that return excess cash to investor pockets through share buybacks, ultimately giving you a larger portion of control of the company. What we can see here, they've done both. They've issued shares, they've diluted your position. Net effect, though, is they have diluted your position, although marginally. What we would say, though, if you were a shareholder over the last 10 years, you really would not care, given how much that share price has appreciated. In terms of ROIC, 12% or more, give us faith management are able to effectively allocate their capital. Very important metric for us. above 12% every single year, 61 in 2024, 87 on a trailing 12-month basis. That is very, very, very high, and many investors and shareholders will find this metric incredibly attractive when they are considering adding to their position or in fact starting a new position. Operating margin not only above 16% is what we want to see, we want to see operating efficiency, which is what we get, and when we've done deeper dives into this company, they also are able to do this to their gross margin. So we have a company, Nvidia, that's increasing their revenue at a rapid rate, increasing their gross margin at a rapid rate, and increasing their operating margin. All signs of what we would deem to be a very high quality company. No surprise then why this company does trade at a premium. Free cash flow margin as well, above 5% every single year, 45 in 24, 49 on a trailing 12-month basis. Again, lots we do love. We then move on to the final metric, the net debt to EBITDA, earnings before interest, tax, depreciation, amortization. Below 1.5 is what we want to see. We're getting 0 right across the board. That is the number of years it would take the company to pay off all of their debt net of cash on hand. What we're ultimately saying here is, over the last 10 years, over the next 12 months, it won't even take Nvidia one day to pay off all of their debt net of cash on hand. That is a phenomenal metric, and again, not one we do typically see on this channel. Now, we want to let you know we have released our latest free weekly article. We drop one to your inbox every single Monday morning, where we talk about what's happened in the market over the last few days, as well as essentially highlighting undervalued stocks that we do believe deserve your attention. And today you will be able to grab access to 36 undervalued stocks for the month of October that deserve your attention. We're going to tell you the upside for each one based on Wall Street, and we'll also flag those that sit within our own personal portfolio. And if that wasn't enough, you can grab a 22 dividend spreadsheet which runs through all of those that have the largest upside according to Wall Street. So again, click on the pinned comment below, sign up, and you can read straight away. Other parts of our analysis on this channel look at institutional and insider movement. Institutions around 65%, around 8 billion worth of sales over the last year, but during the same time period we see a lot more buying, and in fact when we do look at the more recent quarter of Q3, we see the same to be said, and that for Q2 the previous quarter. So institutions over the last year and in the more recent quarter have been buying more shares of Nvidia than they have been selling. And when we look at insider movement, well, 4% ownership, we do notice a fair amount of insider selling, around 1 billion over the last year, and we can see in the more recent quarter, as well as pretty much we get a consistent theme throughout the years, Nvidia insiders do typically tend to sell quite often. Now, in terms of looking at that full transparency, what we can see here, on the 9th of October, the director did sell 155,000 shares, netting them quite a large sum, 20.5 million, and that is something we have consistently seen. And we also note that Jensen Huang, who was selling a lot of his shares over the last few months, has at the moment stopped. Something to consider, but ultimately insider selling isn't something we would say is a bearish signal, as insiders typically sell for personal and financial reasons. Now, we have highlighted here already their top line revenue growth, looking absolutely phenomenal, although we can argue the majority has just come over the last year, going from 5 billion in 2015 to 61 in 2024. Trading 12-month basis, also look at that, massive. So we are expecting January 25 to be a large growth from the previous year. However, what we want to do here is highlight their bottom line. What story is to be told? Well, it does follow a similar trend to their top line, going from 631 million in 2015 to 30 billion in 2024. So clearly this is a company that continues to increase both their top line as well as bottom line. And again, like the trailing 12-month showed for the revenue, their bottom line net income is expected to increase rapidly as well. What about their balance sheet? We already highlighted it is very strong in terms of a health check. Total cash, well, we noticed the trend again. Cash is increasing over the longer term, going from 4.6 billion in 2015 to 35 billion in their latest quarter. As always, remember, we're not looking at any one of these metrics in isolation. It won't tell us anything, which is why we compare it to their total debt numerically and directionally, which has also been increasing over the long term, going from 1.4 billion in 2015 to 10 billion in the latest quarter. But as we saw, net debt to EBITDA is 0, and their cash position is larger than their total debt, meaning, as we've already said, it wouldn't even take them one day to pay off all of their debt net of cash on hand. Now let's move into the gradings. They get a D- on valuation. No surprises, because ultimately their PE is higher than the sector median, and this essentially emphasizes the fact we said earlier, you are paying a premium around 92% right now for Nvidia over the market. Is it warranted? probably is warranted that it is a premium. Is this much of a premium warranted? Well, we're about to show you shortly in our model, and this essentially highlights whichever valuation model you do look at, Nvidia is trading at a fairly substantial premium. Well, good to see. Yes, it's trading at a premium, but their growth is A+, triple-digit growth to the revenue, whereas the sector median, 3%, 87% in terms of forward-looking, still much higher than the sector of 6.3%. And the thing we love to highlight, their earnings per share, 37% anticipated growth year on year over the next 5 years. Sector median much lower at 14.9. We also get an A+ on profitability. That is 76% in terms of the gross margin versus 50% of the sector. Bottom line looking very good as well, 55% versus the 3.75 sector. And absolutely incredible, cash from operations, 49 billion versus the 95 million of the sector overall. So a quick summary for this part of the analysis: a buy from Seeking Alpha, a strong buy from Wall Street with a hold from Quant, D- on valuation, A+ on growth with an A+ on profitability. Now, we also want to understand how has it performed against others in the industry, Taiwan Semiconductors, Broadcom, very large names. We've pretty much covered all of these on the channel, so do check it out. Over the last year, Nvidia up 186%, but what this tells us, this industry as a whole has performed very well. So you could argue if you don't want massive exposure to Nvidia, you also want some security, you could consider ETFs like SOXX, SOXQ, SMH, and I'm sure there are many others. Nvidia, again, over the last 5 years, significant outperformance, but as we can see, the majority of the sector looking very strong. Over the last 10 years, again, pretty much highlighting that fact as we've just mentioned. Important to understand, though, that past performance isn't an indicator of the future. And when we do take a look essentially at the S&P, Nvidia, whether you look over the last year, whether you look over the last 5 years or over the last 10 years, has massively outperformed. Can it do it again over the next 5, 10, 15, 20, 25 years? Well, that's something you need to see if you have confidence in. Otherwise, why not consider a low-cost ETF that just tracks the S&P 500? Now, let's jump into the valuation model. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are notified when these videos drop. Now, our intrinsic value today, $140, which comes from the DCF model. When we run it through, well, we have the free cash flow year on year. We have the growth rate showing the average growth rate over the last 10 years at 94%, 135 over the last 5. And forward looking, we've gone 30%. As you can see, we've gone from a low, medium, and high. With the 30%, with the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get the equity value, divide by shares outstanding, and as we can see here, an undervaluation signal, giving it 6% upside. Now remember, these numbers are subjective and you can grab a copy of this model by clicking on the pinned comment below, whether it's for Nvidia or any other companies that you do desire. Now, for those that want to see for full transparency, at the 25% rate, $101, indicating 23% downside. And for those that want to be more optimistic, at 35%, we can see $193 at the 46% upside. Now, we have one case here of Bloomberg. We put 42%. Reason for this is because last year Bloomberg brought out a very detailed report where they believe the AI industry would grow around 42% over the next 10 years. So just to run that through our essential model, we can show you that 42% would indicate a $300 price target for this company, giving more than a double, so a 125% upside. As we said though, we are going to take through the median rate today of 30%. And when we do run it through, as we can see, $140 intrinsic value. On this channel, we always like to do a margin of safety at 10%, a buy at around $126. And we use 10% if it meets our golden criteria: wide moat, strong financial metrics, and good forward-looking data. So what this means in today's episode, at this price, you are getting only a 5% MOS. Some people will find that sufficient for Nvidia. Some people will want more. As we said, 10% a buy at 126. At 15% a buy at 119, at 20% around 112, and for those that just want to know, $105 giving 25% margin of safety. We also know Wall Street do still consider this a strong buy. They have an upside of 16%, giving them a price target of $153 over the next year. As always though, do give us your thoughts in the comments below. Is this a company you're looking to add after the drop? Maybe you're looking to hold, or for whatever reason you are looking to sell for a certain reason. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter by clicking below, as well as joining us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.